Hi, this is Mitch from Reverse Mortgage Pros, and in this video, I'm going to explain reverse mortgage rates and interest and home equity and how that works. Let's get started. So before I get to the details, it would really help me out if you hit the subscribe button, hit the like button. It'll help get this information out there to help educate and inform Canadians about reverse mortgages and help you decide if it's the right option for you. So a quick overview of what I'm going to cover in this video. It's how do reverse mortgage rates work, how you can run the numbers to make decisions about reverse mortgages or any mortgages, compounding interest and home equity, and then I'm going to give you real life examples of calculations and also show you how you can do them yourself. Before I get into the detail on reverse mortgage rates, as I like to do at the start of every video, I'm just going to quickly give you a quick overview of what is a reverse mortgage in 20 seconds. It's a mortgage available to homeowners 55 and over that doesn't require any kind of payments. You can get around 10 to 55% in the home value depending on age, property type, and location. You can take as much as you qualify for, but any existing mortgage must be paid off first. And it's designed to help you tap into your home equity for retirement and continue to live into your home forever. In this video, I'm going to walk you through reverse mortgage interest rates and explain how interest and everything works as it relates to reverse mortgage. So with reverse mortgage interest, it's added to the balance owed rather than being paid every month. That's why there's no payments with a reverse mortgage. With a normal mortgage, you're paying down the balance owed and paying interest every single month. With a reverse mortgage, you can choose to voluntarily pay the interest, so that's your choice if you want to do that. And then what happens is at the end, the interest accumulates and is paid off when the reverse mortgage ends. I'm not going to go into too much detail on that. I do have a video on what happens when a reverse mortgage ends. I suggest you check that out after this one. So with reverse mortgage rates, they tend to be in the middle of the range with regards to interest rates in general. They're not going to be as low as a top kind of A-level, A-rated mortgage that you can get. They'll generally be quite close to home equity line of credit, and they'll usually be lower than private mortgages, second mortgages, car loans, personal line of credits, credit cards, and other kind of more high interest products. I create this little graphic, and I'll put a link to where you can see it in the information below this video. Essentially, this is where reverse mortgage rates fit in compared to all the different products that are available to lend money, essentially. So they're generally between a car loan and home equity line of credit, sometimes actually are lower than a home equity line of credit as they are right now while I'm making this video, but they're never going to be as low as a traditional A-level mortgage because you're making monthly payments and you're qualified for it as well. So a common question I get is how does compounding interest work? So reverse mortgage interest, like interest on every mortgage in Canada, compounds semi-annually. That's twice a year. The exception to that is actually a home equity line of credit. The interest on that is charged, so it technically compounds monthly. But the good news is that the growth in your home equity can often offset the interest, and I'm going to run you through some example calculations and show you how you can do them yourself later. But it's important to know that yes, the interest does compound. It's semi-annual. That's the same as every mortgage in Canada. So when it comes to mortgage rates, one thing I would like to advise people on is to think long term. A mortgage, including a reverse mortgage, is something that you may have for many years. The current rates you're receiving are important, whatever current rates are when you set up a mortgage, but you actually should think about the average rate you're going to pay over the long term and what that's going to be. And what's happening right now in Canada is a lot of people have made this mistake with traditional mortgages. They got super low rates during 2020 to 2022, around 2%. And some people thought this was going to last forever and they would have a 2% mortgage for 20, 25, 30 years. And now they're finding out that's not the case. So that's why it's important to think long term, think about what the rate's going to be over the long haul, not just whatever the rate is now. So long-term rate ranges, I would suggest when you're running calculations is you use expected long-term rates, not what the rates are right now. So for a traditional mortgage, your kind of A-level top-rated mortgage, I'd expect something in the 3 to 6% range is what over 20 to 30 years makes sense based on where the economy's at and based on what's happened in the last 20 to 30 years in Canada. And so the midpoint of that is 4.5%. So you might have got a mortgage in 2020, 2022, and it's at 2%, and you've actually come out on the on the plus side of this range, but then you're going to renew maybe at 6 or 7%, and you're going to end up on the top side of this range. And over time, that might even out to around 4.5%. For reverse mortgage or home equity line of credit, I'd expect them to be a bit higher. So something in the 5 to 8% range is probably what you're looking at long term. And the midpoint on that is about 6.5%. And this is fairly standard. Usually reverse mortgages are roughly 2% rate higher than whatever you can get in a traditional mortgage. That's what I've seen in my experience with reverse mortgages, is 2 percentage points higher, or 200 bips. So in 2020, 2022, again, as I mentioned, rates were below these ranges, so people didn't factor in rate increases happening when they were making their mortgage decisions, and that's why it's important to think long term. And now, if you're getting any kind of mortgage, the rates are probably at the top end of these ranges, so you might even factor in potential rate decreases in future when you're making your mortgage decision. Again, try and think long term, whatever the rate you're going to be, rather than focusing too heavily on what the rate is right now, because these mortgages will renew in 1, 2, 3, 5 years, whatever you pick as your term. And I have a video on interest rates and terms if you don't really understand how that all works. So what I suggest is pick a relatively conservative long-term interest rate and use this. So the same thing also applies to home equity. So and the same period, 2020, 2022, and even in the last probably 10 to 20 years, house prices have increased many times in many years at unsustainable rates. And you should never believe that your house is going to go up 10, 20% year over year. It just isn't going to happen. 2023, we're seeing things level out a bit, and we're seeing some house price drops in many markets. But again, you should never expect that your house is going to decrease in value over the long run. That's not going to happen either. So a good range for thinking in the long term when it comes to home equity growth and house price growth is to use a range of around 3 to 5% with a midpoint of 4%. So rather than using what's happening right now, think about the long term and what's going to happen with your house price. And again, the focus isn't on what's happening right now in the market, is it up or down? It's what's going to happen in the next 20 to 30 years. So in summary, a good range for considering long-term reverse mortgage interest rates is about 5 to 8%. So you can use a midpoint of 6.5% when making your decision. That might be higher than the rate you got on your reverse mortgage, or it might be lower than the current rates of reverse mortgages. In the long run, it doesn't matter what the rates are right now. You need to think about the long-term rate you're going to pay on this when you sign up for it. So when you're considering house price growth, same idea. Don't factor in that your house is going to grow at 10% if it has in the last few years. It's just not going to sustain that level of growth. So you should use something in the 3 to 5% range, and a good midpoint is 4%. I believe if you look at the last 20-year blocks of house price growth in Canada, they're pretty close to 4% across the country. So what I'm going to do now is I'm going to take this information and show you how you can apply it and look at some real life example calculations using these rates. So I'm going to run you through some example calculations. And what I'm going to do is I'm going to do it on the calculator I built at reversemortgagepros.ca/calculator. And so you can run the calculations yourself. What I'm going to do is I'm going to load that website page, and I'm going to walk you through how it works and show you how to run these calculations and give you some examples. So I've loaded up the page here at reversemortgagepros.ca/calculator. There are two calculators on the page. You can actually click the button if you want to just jump straight to the one that shows you your home equity. But I'll just quickly walk you through the top one here, which discusses how much money you can get. And I put in a little table that kind of gives you an idea of the ranges, because reverse mortgages are advertised as 55%. But really, it's actually 10 to 55% is the range. It depends on your age, property type, location. And again, I have an article and a video on that if you want to see exactly what goes into it. It's linked right here on the page. But the one I want to walk you through in more detail, where you actually can input information, is the calculator. I'll show you how it impacts your home equity over time. And we're going to use what we just discussed. We're going to use and discuss long-term interest rates. So I'm going to give you two examples. The first example is somebody whose home is worth $600,000. So that's what they would enter here. And then remember I said for home growth, a good range is 3 to 5%. I'm going to set it as 4. Again, in the midpoint there to be conservative. You could use 5 if you want to use the top end of that range. You could even use 3 if you want to be super conservative. I'm going to put it right in the middle and use 4. And this person is considering taking a third of their home value as reverse mortgage. So that's 200,000. And when you input this, you'll see here, it'll tell you that, sorry, ignore what I just said there. I'll keep going on. I'll explain what happens there. So then when it comes to reverse mortgage rates, we're going to put it at 6.5%. So remember I said long-term rates are around 5 to 8. We're going to set it to 6.5%. And then you put in the age of the youngest homeowner or spouse. In this case, I'm going to assume that the youngest person is 65. And then what you'll see is when you put this in, this paragraph here is going to update and tell you what the range is. So 21 to 41% is what I would expect somebody with the youngest applicant at 65 to receive as a reverse mortgage. And why is this important is we had the home set at 600,000 and we had the reverse mortgage looking at 33%, a third at 200,000. Now, if I was 55 and that was the youngest homeowner, you can see that I've set that too high. I won't probably not going to qualify for 33% at 55 years old in almost every market, in every property type in Canada. You'd have to be a little bit older. In this case, for example, the clients were 65, and so they would qualify for 21 to 41% roughly, and they're actually taking something right in the middle. Now, once you put all this information in, this table here automatically updates in real time, and you can click on the little plus arrow and it'll load it and show you all your numbers. So here, this homeowner starts with a $600,000 home, a $200,000 reverse mortgage, they have $400,000 in equity, and over time, their home growth is offsetting their reverse mortgage equity. The home equity is actually going up over 20, even over a 20-year period, even with compounding interest, because the house price is going to increase more than their reverse mortgage interest that they're paying. And you're going to see that's fairly common. And I'll try and give you an example where this doesn't happen, but 99% of reverse mortgage holders have equity remaining in their home. And this is why, because the house price growth offsets the reverse mortgage interest growth. So I'm going to give you a second calculation, and we'll do something on a slightly bigger house. So we're going to use $1.5 million home. Again, we're going to use house price growth at 4%, and this person wants half. So they're going to want to take $750,000 as a reverse mortgage. Again, we're going to use 6.5% for the interest rate because we want to use a long-term rate and think about the long-term decisions. And then in this case, you'll see, because we're taking half, at 65 years old, it actually wouldn't work. You'd only get around 21 to 41%. So you probably need to be around 75 before you actually start to, maybe even like 70, 72, 75 before you actually start to qualify for half. So you see at 75, the range is 29 to 53. So assuming that I'm confident I'm going to qualify for the maximum amount. And again, I can help you and give you some quotes and what that number would be. Again, the table updates in real time. And here you'll see that once you get to years 15 to 20, the reverse mortgage interest eventually starts to outpace the home price growth. And this is probably one of the worst case scenarios you'll see when you run calculations. And you really have to be taking close to that 50 or 55% before you start to see in the outer years, the reverse mortgage interest starts to outpace the home price growth. But until year 10, the home equity is actually still going up in this situation, in this example. Then by year 15, the home equity starts to decrease. And by year 20, again, only by year 20 is actually lower than what you started at with your 750. Even after 15 years, you still got more than what you started at, and only by year 20 does the compounding interest finally start to add up. And this is one of the reasons why reverse mortgages are edge tagged. So I showed you that to get this, you probably have to be 75. The lenders don't want you to lose money in your house. They don't want that home equity to be gone. It's not good for them either. They'll lose money on those deals. So what they're assuming is that someone who's 75 probably isn't going to make it all the way to year 20. On average, that person maybe isn't going to get to 95 years old that often, so that might not even see this home equity start to reduce in the outer years. And this is why the age is an important factor in qualifying for a reverse mortgage. So, flipping back to the presentation that I walked you through. So you can see from example calculations, it's not the case that a reverse mortgage eats up all your home equity. And this is why 99% of homes in Canada with a reverse mortgage have equity remaining once it's paid off. So in summary, what I've discussed in this video is how reverse mortgage interest works, that it's added to the balance owed instead of being paid off and that it compounds semi-annually. I went through long-term interest rates and I showed you how it's important to think about those in terms of both home price growth and mortgage interest rates. And that applies to whether you're thinking about a reverse mortgage or a traditional mortgage. And then I showed you how you can run calculations to see how a reverse mortgage impacts your home equity. I walked you through the calculator that you can find and play around with yourself. It's at reversemortgagepros.ca/calculator. Now, if you found this useful and you're thinking about getting a reverse mortgage and you're wondering how much you actually qualify for, I can give you a free reverse mortgage assessment in just 90 seconds. I'll advise you if it's a good solution for you, if something better works, and I'll also help you find the best deal on the market for your reverse mortgage. All it takes is 90 seconds. There's no obligations. It's just assessment form. It's not a full application. It's at reversemortgagepros.ca/assessment. And there's also a link to this on the calculator page that I showed you before as well. Now, if you have any questions or comments about this video, leave them in the comment section below and I'll try to answer all of them. Otherwise, I hope you found this useful and I hope you're able to run these calculations and think about how reverse mortgage and your home equity work in the long term yourself. Thanks and goodbye.